No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. Been talking over the last couple of weeks about a number of things that are going to affect how you invest. One of those being stock returns. So I got into talking about stock returns with regard to some articles and some research out there. There's a lot of it, but McKinsey & Company put out a report recently that was especially helpful. I thought that one of the things that we've seen, for instance, BlackRock, the largest money manager in the world, John Bogle, the founder of Vanguard Funds, Dr. Shiller, who created the Shiller Cape Index, won the Nobel Prize in 2013 for his equity research. We're seeing it, and there are others, but these are all voices saying we're looking at lower returns on equities. All right, now they were talking mainly U.S. equities. Then McKinsey comes out, an independent research group, McKinsey & Company, about why investors need to lower their sights with regard to returns. And they're not talking about just U.S. equities, but they're seeing the same trends with regard to European emerging markets and the whole thing. And not just, excuse me, not just in stocks, but in bonds as well. So one of the things that we're looking at, and there have been other articles as well that have said, that I've talked about, for instance, this one, interest rates lower for longer. And it's talking about not just Federal Reserve policy, but also with regard to demographics and other considerations around, and again, not just in the U.S., but around the globe, that are going to keep interest rates lower for longer. Now, this brings up this conundrum of what do we do, right? If interest rates, if the return on the stock market is going to be so low in a 4% range, if bonds aren't going to be a safe place. In fact, this is one of the other things I've talked about before. What's going on with bonds? If you looked at your bond mutual funds as an example, what you're seeing, if you're trying to get any real yield with regard to bonds, you're having to either go into low credit quality bonds, even junk bonds, below BBB as an example, because investment grade bonds aren't paying very much interest. What's the other thing that we can do? Municipal bonds. I'm going to talk about those in a little bit and some of the pressure they're under and some real dangers coming up with regard to munis. So if you're invested in municipal bonds, you definitely want to stay tuned for that part. But again, on the context of stocks, bonds, and where to put your money, when you look at bonds, yields are lower unless you add risk, which means either longer duration bonds where you're tying up your money potentially for longer, or when you go to sell to get out of those longer term bonds as interest rates do eventually rise, you're going to have very interest rate sensitive situation that's going to cause those prices to drop. The junk bond, higher potential for default. So even though they're paying higher interest, right, there's more likelihood they don't pay you back. How does that work? With bonds, of course, you're loaning your money to either a corporate or a government entity. So just think it's the same in your household, okay, or for those out there. When someone has a low credit score, okay, they have to pay a higher interest rate to borrow money because they're a higher risk. Well, it's the same with corporations and governments. When they have a low credit score, there's a higher default risk, therefore they have to pay higher rates of return or higher interest rates to get people to buy those bonds or loan them that money. And the problem, of course, is that there's a big risk there, and any real economic issues that could go on, pressure on them, could increase that risk for default. So do you even know in your portfolio, for instance, if you've got bond mutual funds, do you understand how those work? And if you looked inside what those bond mutual funds are actually holding as to the credit quality of the bonds, or that again, are there long duration bonds in there? Extremely important. This is going to dictate just what kind of risk or volatility is in your portfolio, okay? And this is something that we're going to, this is one that when new clients come in for the first time, and we're doing that initial analysis, all right, and I offer it up each week for the first 10 callers as an example. And we're going to do it again this week, all right? So what it'll do is this. When you come in, I would take a look at what how you're currently invested, but not just on the surface of it, But I'll dig down, I'll pull Morningstar reports and show you what's in your investments. If you're even investing in mutual funds as an example, we'll take a look and see what kind of what stocks are in there, what kind of volatility is there truly. If you've got a large cap, or do you have just 50 or 100 stocks in there versus 500 or 600? Is it an index fund or is it an actively managed fund? And I'll explain all those things to you as I've done each and every week here talking about these things. But we'll dig down even deeper in your specific situation so that you can see the risk in your particular portfolio. So again, for the first 10 callers to my office this morning at 615-376-5325, Debbie's standing by. She'll get your information to send you out a packet, a checklist of things to bring to your appointment with me, and I will go over Social Security questions, Medicare questions, health care. We'll talk about the Affordable Health Care Act. This is one for those that are retiring before age 65, before they qualify for Medicare. If you're not, health care is going to be a big issue. If you're not going to have that covered as a part of your retirement benefits, then we're going to want to look at what the costs are, and I'll talk about that a little bit as well. So I'll share that with you in terms of how much rates have gone up, what those penalties, tax penalties are with regard to potentially the fees, if you will, for those not having insurance. We'll cover also, again, in digging down into your investments, basically show you what kind of risk there's really there. So you'll know in advance, especially when you're at or near retirement or into retirement, the risk of losses, of drops in the market, of bear markets, all of those things are much greater. And if your portfolio has even more volatility in it because of those holdings, this is something you're better to know ahead of time so that we can look at ways that we can tweak that and make and go with maybe a more conservative mix. I do a lot of times asset allocation modeling for 401ks just for that purpose, to help minimize risk, especially, as I said, as you're leading into retirement or if you're already in retirement. All right, so we're going to talk about those. Here's something I want to share with you as well about municipal bonds. This is one, I've talked about bonds in general, but there's an interesting, this is kind of how to read the tea leaves, if you will, about some of the things that are going on out in the economy and out in the way it affects things like municipal bonds. So here's something to understand. A municipal bond simply is where you're loaning your money, you're purchasing this bond, investing in a bond, which means you're loaning your money to a city, county, state, municipality. Okay, this can be it can be where it's going to be guaranteed by the what's called a general obligation bond, where it's guaranteed by the tax revenue of that entity, or it could be something for a particular project, like a sewer project or a housing project, in which case the success and the revenue generated from that project is all that is actually guaranteeing your return, not the actual, the whole tax revenue, if you will, of that entity. And that's an important distinction with regard to safety. Here's another. We've talked about pension funds in the past, okay? There's some new news about pension funds. A number of articles, in fact, that I came across recently talking about pension funds. For instance, this one in California, pension casino, taxpayers go bust. This is what the kind of trouble they're having there. Wisconsin faces billions in retiree obligations. Public pensions are being overly optimistic with regard to their returns. And this is one of the big ones. When these entities have to create pension funds, so they've got to cover the pensions they've promised to the retirees. This could be teachers, police, firemen, any city, state, county employee that's going to get a pension from that entity. Monies have to be set aside to make good on that promise. Well, the problem is those monies that are set aside are based on a certain rate of return on the fund's money. All right? That's based on the way it's invested in a combination of bonds, stocks, whatever it might be. Well, those returns, as I've just been talking about, are much lower. In fact, the municipal bond market at some point in time down the road will suffer from concerns over the underfunding. These funds are already underfunded. In other words, enough money has not been set aside to meet the obligations that they have to the pensioners. All right, we see this around the country. Tennessee, by the way, happens to be one of the better, but that doesn't put us out of the woods, if you will, because of the problems around the country. What this means for you has to do with basically it's going to be a very broad effect. We're going to have to take a break. So I'm going to have to stop right in the middle there. But we're going to come right back into that. I'm going to talk about the munis, what the risks are, and help you protect yourself and understand when you see what's going on in the economy and some of the things they affect, what it might mean, what the trickle-down effect may mean to you with your investments. All right, join me here. We'll be right back on the Retirement Report.